Hello, Warriors. Good Fed week to everybody, so keep that in mind. Markets are acting like perhaps Powell is going to make some type of statement that will talk about perhaps the beginning of tapering. I don't think that's going to be the case. One of the markets that's really showing that is in the gold right here. And this weakness surprised me, but look at where we are. Okay. This is that long term trend line that we tested last week and held, and now we're right here. We're right at a moving average. So this 1840 level is very important to the bull case in gold, and if it gives away, we could end up with something like this from here. Could take it sharply lower. So silver holding up a little better. You know, gold's taking out these lows to look at the two. I mean, much deeper retrace on gold compared to silver. Silver's still holding this low from, I believe this was on Friday. And what did ECB last week, Fed this week. So the gold silver ratio, even though gold is down, still is favoring silver, even though silver is down, it's still favoring silver. As you can see, it looks like it's developing into some type of bear flag. It could rally a bit more, but you look at this and there is a possibility that we could really fall sharply on this. The only thing that would change my mind, and on every trade, every position that you have to say to yourself, where am I wrong? Okay, so we know from last week and several days have had that test 68 and a half, real important area. And this is why we had some previous lows right around here um, back in December. So in order for this thing to turn 68 and a half, and I thought it was going to do it, and it did help to, favor the long side of gold for a week. But then last week, the saying that I keep in mind all the time and think everyone should write it down, that is, you don't learn how to change your mind in this business, you won't have any change left. So to me right now, the path of least resistance still makes silver the preferred long while we're heading down in this ratio, and gold your preferred short. So gold down 1.5%, silver down 1%. Really not doing anything in the metals. I'm already thinking about the Fed. Not that I didn't do anything. I posted a buy in the main chat yesterday in the long side of Aussie, and I'll be out of these positions, win, lose, or draw before the Fed on Wednesday. And, have had a few pips made, posted it here at the 7701 level last night, have already taken half off. We'll pull the stops back to break even. One of the reasons I bought it was we had this sell off last week, and last week I said I'm going to be patient, wait for 61.8 back. That's what happened on Friday. I didn't buy it Friday. Want to see what kind of follow through we would have on Sunday evening, Monday morning, and when it was still holding the 61.8 level. Hold on a second. Let me just reload this. So when we held that 61.8 level, I went ahead and gave it a shot. So here we go. Put it in the big box. So that's going to be an important level, especially since when you look at it, the Kiwi, which is its sister, its cousin, already took out the low that we're holding a 61.8% retracement in the Aussie. I still prefer Aussie over Kiwi at this point in time. And let's get back to some of the majors and talk about what's happening in Euro. So last week when I was talking about the Euro, I had drawn this line here. I think you could see it pretty good on the 4 hour. And it's coming in this week, 2050-ish or so. The important level for the trend to remain up for one more push up in the euro, which I'm still in that camp, thinking we could trade over the 124 handle. If we have dollar strength into the Fed, and I know I'm talking about it today, and we're still 2 days away, um, I would fade dollar strength for one more dollar decline. You know, I've thought that before we have a more substantial bounce in the dollar, that they still have some unfinished business under the January low. Any questions on anything I've covered so far about the dollar? You know, the market's acting like the Fed might talk about a tapering. I don't think they're going to, and if they do, I think dollar strength will be short-lived because you know, I do believe that the market has to, and you can see the dollar's already fading a little bit. It's my belief that the last dollar bull, and there aren't many of them left, will be gone after we take out the January low, trade towards that 88.5 level, and I'll be looking for the real simple implicator, the RSI, to be giving me some divergence on different pairs for long side moves to the upside in things like Aussie and Euro. Okay, everyone with me? So, taking a look at the pound has really been sideways for quite a while. Look at this whole range up here. And, you know, still my contention that the pound has a chance to rally up to about the 44 level or so. Again, the pound really range bound for weeks. I mean, basically, you could go back to this high. And here we're talking May 21st. So we're talking about 3 weeks of what, 150 pip range. So anyone that has an opinion on this or a trade on this, you know, ranges do not give me biases. I guess the bias would be you have to go with the daily or weekly trend, and you got to think that the daily trend is still up. Look how long we've been going up. We haven't really made a new low, and an important support level for cable would be down here, right around the 140 level. So let's see if um, we get tested there in by the Fed. My preferred long is going to be Euro USD because I do think we're getting close to some type of turn in euro pound. So I'm going to be watching the euro pound very carefully at this 85.40 level, which is about 48 pips away from here, for it not to make a new low and to put in a higher low, so that on the next advance in euro and the what I think is going to be for a while the last decline in the dollar, that the euro pound should rally during that scenario, and you know, perhaps rally back to some important resistance up around the 88 level. So basically another sideways market, but my blue, uh, it could be a wedge line, it could be a channel, but it's coming in just a shade under this 85.40 level. And down there, I would be looking for a turn and a bounce to have something like this happen from around the 85.40 level, which could get us above 88. And that means that on the next dollar decline, it's not going to be cable leading the way. It's going to be the euro leading the way, where the euro will become the preferred long over the pound. Everyone with me on that? Feel free to interject, post charts. If you're watching us on YouTube, recommend you register at TradeGate Hub. It's free. And come in here and share your ideas and interact with me during my live streams Monday through Wednesday, 10 a.m. Eastern Time. I have an interview lined up Thursday with Raksha Soni, who I've interviewed over the years, has a real nice, um, they've developed their own algo called Boomi, and I've seen Boomi perform over the last year or so. That, okay, uh, Mike taking half of his oil off here. So Mike doing pretty well, and that's something else. It's, this community is not only my broadcasts. One of the best stock traders I've seen in my career is with us. So you know, if stocks are your game, check out TradeGate Hub. and my trading warrior brother, Michael Venezia, and Elliman earlier before I come in for the European session. Okay, so let's move on. Take a look at the end. I've been saying I think that there's one more shot up to these highs that we've had two drives right here. Here's one, here's two, and perhaps the yen could make another attempt up here at 1040. It's only about 60 pips away. What's interesting about that level is that you're going to have major resistance. Let me just show you what I'm talking about. It's really on the weekly. If we don't fail on the third drive up here, you could have a major long-term breakout. And, just something to keep in mind. And I know a lot of people, the yen has been sideways choppy, not that easy to trade. But when you keep the microscope away from you and you break out your telescope and you look at a monthly chart, most people don't. I think monthly and weeklies are mandatory to look at to give you, so you can see the forest from the trees and not just see all the twigs on the ground, but you're getting a telescopic view of the end. And this telescopic view in the end was, this huge bull market move that we had almost 10 years ago, 9 years ago. And really, since 2016, which is 6 years, we've been in a real tight consolidation pattern. And we're on the verge. We've knocked on the door one, two, three. Maybe this is the time we finally crack it. This would not be constructive for gold if we're going to get a breakout and head to 120. The correlation is US dollar yen higher with higher yields and lower metal prices as yields. It's all about yields or about opportunity cost. And if yields go up, right now there's been, that's why they talk about TINA. There is no alternative to going out on the risk curve and buying stocks. But let's just take a look at these yields. And last week I talked about that we were having a breakdown on the 10-year yield under the 148 level, and I think we're testing it right here. So here's your 10-year yield chart. And this was the breakdown. We've rallied right back to it. So we're going to see if we pull back one more time. I actually don't think it's a low. Okay, so here I'm showing a very long-term chart. That's a monthly. And you could see that this was a pretty major turn in 10-year yields from what we had last year at a little under 50 bips. In fact, during the COVID, we got down to 36, but after that, 50s were the range, never even challenged the COVID lows. So yields have been rising with the bull market and everything. It's all one market, so we've had a weaker dollar since COVID, right? Weaker. Here's your monthly. This was COVID up here, and the dollar declined, which helped many different asset classes decline well over 10%. So, S&Ps have doubled, so you can't say it's just a weak dollar that did it, but there's at least 15% nominal gains in anything that's gone up since last April because the dollar's fallen that amount. So it does translate into nominal gains. In fact, if you go back to the Great Recession or the dot-com bust, as soon as the market started coming back after the dollar weakened, and the weakening of the dollar really in I think it was '08, you had a 30% decline in the dollar, and most of the gains at the initial rally out the hole in 2008 in the S&Ps from 666 was dollar weakness. We rallied 30% in the market. Then other fundamentals began to take over, especially TINA. No other alternative with where rates were and where they were kept with, you know, major monetary stimulus, not as much on the fiscal side, although there was a big tax cut under the Trump administration. So just looking at what's happening here in the 10-year, a little shorter term, as we're bouncing right back here. I think this is the market saying the Fed's going to, um, you know, say something about tapering. So you have lower gold. This could end up being a false breakdown. I mean, this was a real big level that held for months, months. Okay, going back to March, we were in this range. And you know what? There are a lot of false breakdowns, and one I pointed out last week was Bitcoin. So they're actually great trades because you get people wrong-footed on the wrong side of the market on a breakout or a breakdown. I call breakouts markets that are moving to the upside and breaking out for a move higher, and breakdowns are a failure of a market breaking down and trending lower and heading towards what may be the next support level after the breakdown. But my point being that you get a lot of false signals in this business, and you have to be open to, if the reason that you got short um, yields and probably bought bonds um, was a breakdown, where are you wrong? If we start to negate the breakdown, that's where you have to say, well, you know what? Was this breakdown real? Now, if it tests it and comes off, there's nothing wrong with testing breakouts and breakdowns, but negating them, you can see what could happen. So, um, just keep an eye on this. We start getting closes back over this breakdown level. Perhaps we're on our way to higher yield. So this is a Fed trade all the way. I'm not going to even attempt to forecast it, but let me just follow through on my thought and my coaching about what you do and how you react to false breakdowns. And that brings me to Bitcoin. So I had this flag formation, and I didn't think it was going to hold, and we had a breakdown. See that under the green line? And then I said the only thing that would negate this breakdown is closing back inside of the flag formation, and I put the posts out. I think we're around 34,000, closing back inside. Could look at some shorter term stuff, and if I extend this line out. And then what's interesting about this line, if this is it, that's not it, is we came back and back tested it. So let's take a look at this now. Go to the daily. So here was the flag line right here. And as you can see, look at that this day. So we had a false breakdown right here. And I said, really, this is the first buy signal in Bitcoin all the way down. And it wasn't any kind of breakout, it was just a false signal. And then we made our initial move up, and look what happened on the pullback. It stayed within the formation. And now, like I said, the trade was getting long on the breakdown being negated. And now the next hurdles are, I just posted this in the main chat. It's going to be these two moving averages that seem to be converging on each other on the daily. The 50-day coming in at 42.5 about, and the 200-day coming in at 44.6. So there should be some sellers up around, the big round number 40 to 42, and we'll see. So, my target from up here in the third drive was 36, which it overshot. But again, this is a prime example of a false breakdown. If you're not familiar with how to trade it, take a screenshot so you'll be prepared for false breakouts, and downs uh, down the line. And they're great trades because how many people got short on this breakdown, and I thought it was a breakdown too, and that we might head towards 23. But that day it closed near the high, and I posted in the main chat that it could be a false breakdown, and you go with it on the first candle back inside of it, and that was all the way down here. Okay. So if you took the false breakdown signal and got long, you got long at about 34,000. I'll give you the high of the candle. And then we had this initial run to 38, pull back, and here we are, um, acting. acting pretty good. So this too could be some type of moment of truth. Also, I want to point out, and I brought it up, and I still don't understand the whys behind it, but there is seems to be, and it wasn't my idea, a friend of mine who I've known for over 30 years, who writes a great newsletter called Macro Tides, Jim Welsh, was talking about the inverse relationship between Bitcoin and gold. And, up until last week, gold was going up, right? Getting a nice rally from support here if you did anything about it. And Bitcoin was going down. So there is some type of negative correlation between gold, just something to keep an eye on. Strong gold usually lately has meant weaker Bitcoin, and weaker Bitcoin has meant stronger gold. So just another, uh, yeah, that's a nice candle. So, I mean, this could have been it in gold. I had this line drawn for the last couple weeks, and here we are. We tested it. In fact, I posted this chart in our main chat, which you may hear me in this live on YouTube or the recording later, but it was much more useful when I was talking about major support being tested here before it even turned. So check out the chart in the main chat at TradeGate Hub. So if I'm right about one more turn down in the dollar to new lows, you would expect one more high in gold. So I would say now you have a pretty good line in the sand. I don't think you want to be long gold back under this channel breakout. And this is a test. And we're getting a nice little wick on the gold market here. Let's take a quick look at silver. Not as dramatic in silver, but silver has held up so much better. I pointed that out. Look at this. Classic held this 2750 level. If you're long silver, get out of the way under today's low. Okay, if you bought this dip, here's your stop loss point. If you bought this dip, you take half now. If you did anything after I showed gold at major support earlier in the morning. I do want to you know talk about that Nasdaq has made new highs. This is a forecast that I was making down here, that we could still rally to new highs in Nasdaq. I don't think we're complete yet. I think that there's a chance for 14.3. That's another 2% or so. Whereas the S&Ps put in a high earlier this morning or last night at the 50 level up here, and it's come off pretty good. I'm still not ready to short it. You are getting a nice day in the VIX, so maybe something's happening. You have a nice little pin bar. We did break to new marginal lows, and we're still diverging. So it's not easy to sit on my hands and do nothing, looking for a major inflection point in the equity sector. But we'll see what plays out in front of the Fed. I'm not going to place major bets until they're out of the way. Um, so S&Ps are showing some relative weakness compared to Nasdaq. There's S&Ps, which is a change, because the Nasdaq took a long time to finally get up towards taking out the highs of the move, which were made back in April, near the end of April. So what I'm looking for here over the next couple of weeks is see what happens at 14.3. As you can see on the daily, we are diverging, and even 2-300 higher we may. And what kind of formation do we have here? This is something I've been teaching here for a while. Let me give you, just kind of a history lesson. Here's Bitcoin. 1, 2, 3. Who could count to 3 with me here? All right, so this is a classic 3-drive formation with the last high having relative strength reading under 70. So keep this picture in mind, and now look at NASDAQ. 1, 2, and now in the process of developing a third drive. So This is something that I thought was going to evolve, that the Nasdaq looked incomplete with just these two highs here, and now I believe that we're on the verge of completing towards month's end, and that risk off probably doesn't happen because of the Fed, but happens a few weeks after the Fed into the end of the month. And this looks to be on track. Be careful. I don't think a lot of uh, internals are confirming this in NASDAQ. Um, Mike Venezia put up a real nice tweet and interview by Mike Santoli on CNBC. And Mike's got a great feel for the market. And there are a lot of things under the surface that are showing some type of cracks in the armor. So if the market's going to accelerate from here, I don't think it's going to accelerate from here with a strong dollar. It needs one more wave of dollar weakness to complete for another 2 to 3% rally in both S&Ps and Nasdaq going into month end. So that's going to be a wrap for me today, everyone. Remember, keep in mind that whatever you do, if you're scalping here, that you get flat before the Fed announcement on Wednesday. We'll see what type of follow through we get to today's action. I think this was a real nice recovery in gold. Great break to buy. And we'll see what if the Fed just helps inflation hedges move higher by not talking about tapering. If this holds, there is still a possibility for 1960 or so in the gold. And with that, don't just count your shares, don't just count your cryptos, don't just count your gold bars, count your blessings. Good hunting the rest of the day. Remember an excellent interview coming here live on Thursday with Raksha Soni and her boomy indicator. And I'll see you in the chat room with updates as the day progresses into tomorrow's session. Thank you, everyone. Adios.